Hey traders, Nick here. Wanted to recap a violent week ending 12/7. Okay, so the day started great right up here, and then this is the same thing, the S&P at different time frames. So it started great and then we fell apart. We backtested yesterday's breakout, which was normal. What wasn't normal is right around here, Peter Navarro, part of the Trump team, decided he's a China hawk. He actually wrote a book hating China, something that Death by China or something like that. So I don't know why people are surprised when he comes out negative. But apparently he didn't get the message that there's a truce going on, and he decided to come out and say that the tariffs are coming if we don't get a deal done. Like, we know that, yet he decided to say it today, and the markets tumbled hard. There were signs in the early goings on. Tech rolled over. Speaking of tech, I think you can put some blame on Crapple. No, that wasn't a mispronunciation. It is a play on words on Apple and crappy price action. So markets will find it difficult to rally with down 2% on Apple, which is probably directly brings in about minus 0.3% on the Qs, for example. Just from that action alone. If you bring it back to zero on Apple, unchanged on the day, 0.3% will be less. The hurt will be 0.3% less on the Qs, for example. Okay, back to the day. The day ended, it was a good day, flipped to really bad, and a bad way to end the week. The week is also red, and erasing a whole bunch of hard work from last week, which was really great. So, 1 foot forward, 1 step forward, 1 step back, and hopefully not 2 or 3 steps back. More on this later. I'm going to try to scare the bejesus out of us because there is definitely things to worry about. And this is just a perfect example. If Apple loses its footing, and it's like right there, it could come down to 150, 152 at least. It does have support. This is a well-consolidated zone. It shouldn't lose its footing. But nevertheless, people will act on impulse, and they won't respect. It's a rubber band. It's not a hard line in the sand. Okay, so that's the Apple scary part. Now, the other scary part. Let's start with next week. Next week, it's all about, other than the headlines, of course, it's all about. We have some inflation reports. Those go towards directly towards the Fed fears and the inversion of the yield curve. Tame inflation data will mean that the rates should fall and bonds rally, and movement in the yield curve. How the markets will perceive it, I don't know. Usually when bonds rally, stocks fall. Today was a perfect example of it. The reaction to the jobs report in the morning was wrong. It was a tame jobs report, yet bonds fell. So anyway, they should have rallied, because a tame jobs report means the Fed is not going to tighten, so rates should have fallen, yields should have fallen, and bonds should have rallied. Yet it was the opposite happened, and I made a note and I said, okay, I'm booking calls because this is not normal. So anyway, back to next week. It's all about, we have some retail reports. We have definitely inflation data. They're both important towards the fundamentals of the economy, the macroeconomic picture right now. And of course, we have the headlines. Will they, won't they come back and defend, oh no, we're still doing great with our China relationship. And even the Chinese are coming out with nicey talks, even though the U.S. arrested the CFO from Huawei. I don't know how to pronounce that. But anyway, so next week is important. Note, I am confident that something happened this week with the data, with the trade on the Dow. There was a funky trade, a huge 5 million shares in the middle of the day. Nobody's talking about it, and that was the high of the day, high of the week. And something broke that day. I don't know what. I'm missing a piece of the puzzle. I'm humble enough to admit it. Other people won't admit it, but I am humble enough to admit it. Let me see if I can show it to you here. If not, I'll include it in the write-up. It's hard to see here. So, oh, there it is, right there. So here's something. This is the DIA, the Dow ETF, right there. Look at all the volume. You can't even see the bars, and this bar is like up here. You can't even see you can barely see all the other bars are way down here. And boom, middle of the day, out of nowhere, and that marked the absolute top. Look at it. Look at the volume right there, that yellow bar right there. So here's the other volumes, and something happened there. So if that was bogus, then I want to bet on us going back to it. So that's the only upside bet I like here. So a break above this level right here, 250 in theory, should bring a test of that. So buying DIA calls here is a real gamble because we got so much going on before that. So if I do buy that, I make sure that it's small money as a bet. Bet meaning like Vegas. So I don't risk a whole bunch of money. And if I do, I have to protect it somehow. I took that bet. I used late December, and I'll put it in the write-up. So I don't know what happened here. People ignoring it. Nobody mentions it. It shows up on many platforms. It's not like this platform is broken. So it's something that I don't know about. I want to see what happens. Okay, so now we have things to fear. I'm going to go back to, I'm going to try to scare us as much as possible. Okay, this is the SPY, which is the S&P. It's just an ETF. And if we lose footing here, there's a whole bunch of downside. Okay, so mid 50s to low 50s can come in an instant, in a blink. Look at this day. So this is doable in one day. All it takes is one stupid headline. I'm not calling for it. I don't think it should come. But if it does, I have to be ready. What does that mean? If I'm long a whole bunch of stocks, I should buy puts in the S&P. What do I buy? I buy something to cover the disaster. I don't want to spend thousands protecting hundreds. I spend hundreds protecting thousands if I have a lot of longs. So I would buy 2 weeks out, 3 weeks out at max, and just bet on a big downside that I want to capture. Okay, so that's how I defend. So the S&P is a little scary. Apple I already covered. The XLI, which are the industrials, also I will share a chart. Starting to look like it's testing a neckline, right? If I expand it, I can draw head and shoulders. Once they lose this neckline, they're going to wish lower. These are in the direct line of fire of the China trade, so be careful there. There are a few other trades I mentioned in the write-up, but they're bets. Believe it or not, Tesla is green today, and that's one of the bets. Whoops. But it's also a bet on the market in general. So it does have a breakout to 420, if not more, but it has a lot of failures to overcome first. This failure, that failure, this failure, this failure. So it's a zone. It's not a rubber band. I took some calls, just lottery ticket. I have a lot of profits from Tesla this year, so I'm just throwing some money at it. Somebody mentioned the FXI, which is a direct China play. It is a wild card here. It does have an inverse head and shoulder pattern, but I'd rather chase it when it breaks out of the fail zone. So I'll put more on the write-up. The bottom line is something is going on in the market that is above everybody's pay grade, and not many people are willing to admit it. I am. And there's definite risk to coming down to 2400 in the SPX. This is the SPX. Okay, so why? Because I'm going to scare you as much as possible today, because I'm always optimistic, right? I'm not turning bearish. My opinion is still exactly the same, but I recognize the threats that are here. They're testing this neckline that looks like a head and shoulders. Everybody's talking about it, death cross or whatever. The downside potential is this big. So this is where I think they stop first because of this little jag here, and they could go a lot lower. We are just still a hair away from all-time highs, even here. It feels like a slog because we did a lot, but the downside potential is horrendous. Don't think it cannot come. 2600 will trigger sell programs, and then 2440 would be that. So how do I defend against that? Plenty of ways. SPY puts, SPX puts, or spreads. Credit call spreads, which I least like, but they work. Debit put spreads, they work. Depends on what I'm long. If I'm long a lot of Boeing and stuff, I would short the DIA. If I'm long tech, I would short the QQQ. If I'm long other stuff, general stuff, I short the SPY. If I'm long SFIX, which reports Monday after the close, I believe, double check, I would buy puts in SFIX itself or change my risk to be less volatile. So a lot to do. Nick signing out. If you have any questions, let me know.